George, thanks for having me and accommodating the schedule. It's my 10-year anniversary on Thursday, so I'm on a very short leash. I think the best way the presentations I enjoy the most, and I think people get the most out of, are very conversational. I've got a whole bunch of slides, 20 or 30 of them. They're merely reference points. Feel free to ask any questions along the way. I think it just creates a better experience for all of us. George gave the introduction, but who actually is Pender? A lot of people in Central and Eastern Canada may have never heard of us before. We're an independent firm out in Vancouver. We started in 2003. We offer a suite of small, nimble funds. I think when you look at the types of funds that can actually outperform over the long term, it's not a $20 billion closet indexer. It's a small, nimble mandate within its asset class. You employ a concentrated value-based approach, and the PM is invested alongside you and the clients. So I think when there's that aligned interests, managers tend to perform a lot better. Our goal, we want to create value for our investors by generating superior risk-adjusted returns over the long term. So what is the Pender way? Our key differentiators: we seek to obtain more value than we're paying for. We take a private equity approach to public markets, and I'll drill in more on that because really when Pender was founded in 2003, and my career prior to that was in private equity, we try to think independently, and we're patient opportunists. We manage concentrated idiosyncratic portfolios. We really focus on owning businesses. When we talk about people on the team, we don't have stock analysts or security analysts. We talk about being business analysts and industry analysts. And knowing what's going on. We're occasionally contrarian. You can't always be contrarian, and we're aligned with our investors. Everybody here's probably heard of these two books. They're the two most influential books I've read on investing. Obviously, The Intelligent Investor speaks to value investing and is wonderful. I started my career in 2000, and I was investing in earlier stage technology companies. And if you remember 2000, well, value investing and technology were complete oxymorons, although that corrected relatively quickly. And for me, it was quite challenging dealing with a whole bunch of very growth-focused venture capitalists, where I was trying to figure out, where's the value here? And I was pretty lucky because just in my usual course of reading everything about Buffett, he mentioned he really, thought highly of this book, Common Stocks, Uncommon Profits, and written by Phil Fisher. And I think that was really where the eureka switch went for me on applying a value discipline to initially investing in technology companies. And it's really driven our investment approach today and how we're different. I think when you look at private equity, there's three key aspects to private equity. First, it's buying a business you understand in an industry you like, and it's really digging in and doing deep due diligence so you understand the opportunity. And Phil Fisher coined it his scuttlebutt research and due diligence. So there I am, sitting in my office 12 hours a day, reading about companies and reaching out to do channel checks and talk to competitors and suppliers and looking at our private companies. And I was like, wow, he's doing the exact same thing, but he's just doing it in public companies. So that was very influential to me, but it speaks to being a business analyst, and you want to know the business you're invested in because that really helps you navigate market turbulence. Because when volatility spikes up, and every now and again, fortunately it does, we love that. When you understand what a business is worth to the underlying owners of the companies, or what the competitors would pay any given day, when volatility picks up and that stock goes down 50%, you have the utmost conviction to buy it. If you don't understand the business that well and you're kind of really worried about the risk factors and whatnot, the moment that stock's down 50%, all you're going to be worrying about is, oh my goodness, I think that risk factor is going to come to play. You will never pull the trigger. So having deep knowledge and understanding of the business and what the company's worth to the people who run it and the people who may potentially compete against it and buy it is critical in the investment process for us. The second part of a private equity approach, you can create a lot of value on the buy side, But then you get down to work and you actually have to go out and build companies. And I think this is, most public markets investors tend to be quite passive, and they make an investment and they watch their screen, and then if it goes up, there's high fives. If it goes down, they sell it and forget about it. There's a tremendous amount of value creation that goes on in the companies. And for me, I've sat on numerous boards over the last 18 years. And what that's done is I think it's given us a lot of insight into how management teams build companies. We've seen good management teams make good decisions and build good companies. We've seen bad management teams make bad decisions and blow companies up. I mean, we've also seen bad management teams be extremely successful. We've seen good management teams just luck doesn't play in their favor. So really, having worked with a lot of management teams, I think, my partner Felix, he keeps on asking me to write down like our checklist of what we look for in a management team. I drive him crazy because I always tell him it depends. Every single situation is unique, and you're never going to get it right. But when you're assessing management teams, what you really try to do is stack the odds in your favor. And there's one of the key attributes we definitely look for, and it's really driven. A lot of founders have this, but it's a lot about grit and determination and perseverance. Has anyone here read the book Shoe Dog? Phil Knight's biography, Building Nike? Yeah, okay. Anyways, Bill Gates called it the greatest gift to entrepreneurs. I grew up in a generation where Michael Jordan was the greatest athlete on the planet. Air Jordans were the coolest shoes out there. Nike was just this amazing company. You read the Phil Knight's biography, and you can kind of see that for, I think it was probably about 20 years, he was 1 week away from losing the company every single day. It was really enlightening on how hard it actually is to build businesses and the perseverance and grit that's actually necessary to do so. The other thing it allows us to do is when you've been in board meetings and you hear how CEOs talk about the operating results of their businesses, it gives you a much different lens when you're reading through public disclosure. I think there's a lot of nuances that go into public disclosure, and trying to figure out what management teams actually mean when they say something there's not a lot of science to it. It's a lot of art, but every edge you can get there is as in your favor. The third part about private equity is you buy a company, you build it, and then to actually make money at the end of the day for your unit holders or fellow shareholders, you have to go sell the company. And it's in private companies. There's a lot of different scenarios that come into play. Everybody's favorite is when a company is just doing gangbusters. So it's growing at 40 or 50% year over year, increasing cash flow. It's on the front page of the newspaper, and those companies are really easy to sell. There's a lot of people that want to buy those types of companies. So you engage some investment bankers, and the process usually runs its course. Where when companies more often than not are doing okay or not doing as well, that's where we've had to get a lot more actively involved in the sales process. And I think what that's done is there's two key aspects of that for us. First and foremost is if you've actually been involved in the sales process of a company, it helps you understand what buyers are potentially looking for. It helps you understand what they're modeling. It helps you understand what the sellers are presenting. So it really helps you to get in the mind of a private market buyer of the company. And this really ties into how we operate as value investors, because what we're always trying to figure out is what another company is going to come along and buy the business for today. And I think where we get a bit more insight is because we've actually gone out and sold companies and been on a buyer and a seller and been deeply involved in these transactions. We think we have a good chance of getting inside the mindset of a potential buyer of a company and what they would potentially pay. And I can tell you right now, we will be precisely wrong. There is no exact value, despite what the auditing profession would have you believe. But if you can get it pretty close, you're going to do extremely well in this business. So, does value investing actually work? I realize I'm preaching to an audience here who obviously does believe it works, so we can all just cheer as I present all the evidence here.
I'm glad you're saying it is because if you said not working.
So, I mean, this is an interesting study that came out in 2015. And what it shows here, on the left is active share and mutual funds. So what's really interesting here is as the active share increases, the returns become less index-like. Interestingly, with the top decile or top quintile active share, you're still going to underperform the market. Then if you look at the chart on the right there, the turnover. So if you look at the most patient portfolios, so the lowest turnover, as you decrease turnover, you suck a little bit less. You still underperform the market. But what's really interesting is if you put the two together. So if you have both a highly concentrated active portfolio with incredibly low turnover, you can generate over 200 basis points of alpha. So that seems like a really good idea. So we should just all run concentrated portfolios and long duration. What's really interesting is the top quintile, so the top 20th percentile of active share means I believe it's 82% active share. The top quintile of long duration portfolios is 24 months. I mean, we're looking 5 years out. We think 24 months is short term, but if you're holding your stocks for 24 months, you're in the top quintile of long duration portfolios. And the best news is nobody's doing this. So, I mean, I think to have a competitive advantage and outperform, you need to have very little competition. And what we see right now is only 3.9% of assets in the United States are actually managed this way. 96.1% are, I don't know how they're managed, no way that I understand, but only basically 4% of people are managing capital this way. So that's a wonderful opportunity for everybody in this room. Why small cap? Well, because that's what interests me, to be quite honest. But we do think that small cap, there's a lot of studies out there that show if you're invested in small cap, you have a better chance of outperforming. And we just kind of asked here's kind of the evidence. Micro cap, you can do really well. Small cap, very well too. As you get into larger cap, your chance of outperforming is less and less. And why is that? It's because if you find the right small cap stock, if you can find a company in the early innings addressing a really big market, it can grow for a really long period of time. And what we know is in investing, the returns you get, it's not the day-to-day fluctuations and the change in sentiment. Over an incredibly long period of time, it's the earnings power of the underlying companies. I think the data is the S&P 500 has returned, give or take, about 6% over about 100 years. And then if you look at the earnings power and dividends of the S&P 500 over that same period of time, it's basically about 6% as well. So over the long term, you get the fundamentals of the businesses you're investing in. If you're investing in a mega cap today, Johnson & Johnson are one of these companies that are growing at GDP plus. It's actually impossible for them to increase their earnings power at double-digit rates of return for a really long period of time. If you've got a $100 million company getting to a $10 billion company, you can compound for a really long period of time and be a really happy investor. So law of small numbers really kicks in here for you. Any questions so far?
What is the definition of small cap in your case?
I look at small cap as sub 1 billion market cap. Yeah, it's a moving target for a lot of people. Some people call it 5 billion. We skew smaller than $1 billion in a lot of our portfolios.
Canadian or US? Or do you differentiate small cap in Canada and the US?
We say 1 billion in Canada, and then our technical definition is 5 billion US, but we go 2 billion US would really be the core of our small cap holdings.
How is the mortality rate there?
Pardon me?
How is the mortality rate for small cap companies? Because they don't go through the culling process. It takes time. Large cap companies have already management systems built in, business templates pretty well done. They just need to scale up further. So how does it happen with small cap companies? They need a lot of processes to come through before they start making money.
It's a really good question. It's, when you look at small cap companies, there is a wonderful opportunity right when they are hitting operational scale. And this speaks to your question because small cap companies, they're losing money, and in the early stages, what the CEO has to do is they have to say, we have very finite resources. How are we going to deploy those resources in order to increase the value of the business? And a lot of times it goes into either product development or sales and marketing, because you need to build your revenue first and foremost to create scale in your business. Once you start to get on a path where you've got visibility to break even, that's when you can actually start improving processes, introducing new policies and procedures in building your company out. And so there's an evolution that goes on. What we see is, you can generally figure out, if you can figure out what the operational break-even point is for a business, then you can figure out what they're reinvesting in sales and marketing or research and development in the case of technology companies in that future growth, so you can understand how scalable that business is. Can you ever be certain that they have all the right procedures and policies in place? No. I mean, do you want, I think if you have someone who's run a Fortune 100 company, if they were to come into a $100 million revenue company, that's a really challenging thing for that person to do. So there's a right time and a right place to introduce a lot of the systems that you're talking about. Knowing when, it's definitely a judgment call by the CEO.
And how old are these companies? Typically, what would be the age of these companies? An average age or something like that? Yeah,
I'm not sure what the average age is. We have companies in our portfolio that have been around for 5 years. Companies in our portfolio that were $10 billion companies in the .com boom and then fizzled out and then have totally reinvented themselves and are now on a wonderful go-forward strategy. So what we do like to do is, in the earlier stage of a company, what we try to do is meet with management as long as possible and start building out basically a scorecard or a track record to see, to start assessing the quality of the management team. When businesses have been public for 10 or 15 years and you've got this wonderful treasure of publicly available information, you can generally assess management teams by their public disclosure. But in the earlier stages, it's important to have those one-on-one conversations to build out those track records. So there's a question right in the back.
It's from an earlier slide, but just on your point about just framing the liquidity exit event when owning a company. I was wondering if you could just kind of elaborate on that a little bit, and just how you think about that and how that changes as you own a company.
So just to focus my answer a bit, would you be referring more to historically on the private equity side or in public markets? Public markets. So, on our sell discipline, what we're always looking at, we're always asking the question is this company continuing to build value on a day-to-day basis? And is our investment thesis still intact? So if those two things are in place, then the only reason we would probably sell is due to valuation. Where it gets a bit trickier is where your investment thesis breaks down, and then you can ask yourself the question: do we just want to move on from this opportunity, or is it worth it to maybe go to the company and suggest that maybe it's you've got these hiccups. Storms gathering on the horizon. Maybe it's a good time to sell the business and then work with the company to execute on that. So how you approach it really depends on where the company's at and how it's executing.
Just curious, how do you think about negotiating board seats? Do you do that sort of based on position size, or do you sort of always try to work that as part of your investment? Or how do you think about that?
Yeah, we don't like to go into a company, build a position with the intent of having a director go on. You know, it's usually what happens for us is we see a particular issue where we think we can be of assistance, and we might know somebody who would be able to help the company out, either in terms of working with the company on their sales and marketing execution, or maybe it's, you know, as companies graduate, you know, from a $50 million company to a $500 million company, you know, the level of public disclosure you need, the governance requirements start increasing quite a bit, and having someone to help guide them through that. So it's really, we don't like being activists. We do like engaging with management teams. We like helping build companies. We love building businesses. So it's really, if we think we can help, then we'll offer our assistance. Sometimes people say yes, sometimes they say no.
Can we just finish the presentation at the end? We can go over the more questions.
Okay. I think it's always interesting to talk about a current name in the portfolio. I love consumer companies because they're totally polarizing. How many people here hate Freshie? How many people here love Freshie? Okay, 2 of us. Maybe not so polarizing, everybody hates it. All right, maybe the people bought the IPO, I don't know. So Freshie, the investment thesis, it's a founder CEO with missionary characteristics. Matt's the founder of the company. He started, borrowed money from his parents, started building fresh bowls behind the counter. So he's done everything in this business. They have an innovative menu. They leverage some very big trends. It's a very cap-light business model, strong unit economics, mass market appeal, really in the early innings. And what we really like about it is the market just hates it right now. Kind of encouraging that a lot of people in this room hate it right now. We think it's uniquely positioned within 3 big trends today. One big trend today is health and wellness. Another is the cohort of millennials. And the third is affordable entrepreneurship. And I'll get into each of these in a second. But why is the company in the penalty box? Well, the Bay Street, Wall Street view of this, they totally overpromised coming out of the IPO. They were very aggressive in their forecasts, in their store rollouts, and they totally missed. And I think, you know, when you have a young management team that's never gone through the go public process before, and, you know, they start going around, you know, they get excited, they're going to overpromise, they can come across as potentially arrogant. A lot of investors don't like that. So when you miss a quarter, everybody's just gonna smoke them. But the Main Street view, I mean, Freshie's fast casual top brand of the year in 2018. It's the second fastest growing multinational chain. It's the best workplace culture at the Canadian HR Awards. And I think, you know, culture is more and more critical in building businesses today than it's ever been, particularly in these people-driven companies. So, you know, the Main Street view is very different than what Bay Street and Wall Street are looking at today. And missionaries build great businesses. You know, it took Freshie 11 years to get to 200 stores. McDonald's, it took them 12 years. Subway, 16. Domino's, 18. They've had 20 quarters of positive same-store sales growth. And if you look at the entire industry right now, I think same-store sales growth is probably negative in restaurants right now. So pretty impressive metrics. And sorry if there's any consultants here, but, you know, consultants don't create cultures, missionaries do. I think it's the 5 guiding principles at Freshie. I think this really speaks to, you know, the culture of the business. You know, I don't have to read this. I think everyone can read these, but, you know, the more you interact with the management team there and you talk to franchisees, you really understand that this is embedded right throughout the organization. And one of the things we're always looking for is pattern recognition or commonalities. There's some wonderful businesses out there with established moats, 3 of which we've been invested in: Panera Breads, Chipotle, Starbucks. You also look at Subway, McDonald's, Domino's. And what do all these companies have in common? They're all missionary-led. They are all food innovators. They all have superb unit economics. They all had large runways with mass market appeal. And many of these companies embraced financing, or franchising, sorry.
You don't have Tim Hortons there.
I don't. Too polarizing in Canada right now. Commonalities we'll discuss a little bit. So if you look at Subway, here's the largest QSR in the world by store count, 40,000 plus locations. And why is that? It's incredibly convenient. It's got really low upfront capex costs for small footprint stores. There was a healthy perception around Subway, maybe not so much anymore. It had mass market appeal across demographics and barriers. In Subway, you could customize your sandwich. I mean, that was pretty novel back in the 80s, 90s when it really took off. And they all had dual-pronged franchising. So Subway catered to both solo entrepreneurs as well as master franchisors. And if Freshie today very much has all these same characteristics in play. If you look at millennials, 2/3 of franchise partners and 90% of headquarters staff are millennials. It's the largest generation. It's increasing in size, and then we got Gen Z coming right behind them with similar characteristics. Millennials are most likely to eat their veggies. I think there was an article in either the Globe or the Post today talking about how the meat industry was all concerned because, if you look at, I think it's whatever percentage of Canadians are now vegan or vegetarians, it's like 75% of them are millennials. And that's really scary for the meat companies around the globe today, but really an opportunity for some businesses that focus on health and wellness through vegetable plant-based diets. And people want to eat out and customize, so Freshie obviously does that. If you look at the same-store sales growth for a couple great brands, I mean, Domino's is absolutely just killing it with their mobile strategy. Starbucks is doing great. Freshie's number 3 there at over 5% same-store sales growth from 2010 to Q3 2017. So it's in very good company. And then you look at the unit economics of a Freshie franchise. A typical restaurant's $1 million plus. You need 1,500 square feet. You get 15% unit economics on that. Freshie, it's $250,000 down, about $250,000 to build it out, and be flexible, 400 square feet, and 40% return on invested capital there. So, when you look at affordable entrepreneurism today and people looking to build their own, to have their own company, this is a wonderful opportunity for them. 7,000 people applied to have a Freshie franchise last year. They only accepted 150 of them. What's really a good sign of strength in any franchise model is the number of existing franchisees opening new franchises, and 30% of new franchises are opened by existing franchisees. And just these low square foot, and there's no kitchen equipment required, so it really drives the store level economics. Not only with the individual franchisees, but they have some wonderful master franchise agreements in place. And kind of draw your attention to the third point, Anil Patel. He was the first franchisor of Starbucks in the UK. He's rolling Freshie out in the UK, so there's some wonderful optionality there. 90% of locations are still just in North America. They're using these master franchises agreements with like Airmark and Compass, going into the the major sports arenas and schools and airports around the world. So.
I just interrupt for a second.
Yeah.
So a lot of the information you're using to build a very qualitative case, where do you source that information from outside of what's been publicly disclosed by the company?
This is all publicly available information.
Is it from the company, or you go to like trade magazines to learn more about the industry?
It's combination. Yeah. So in general, it's publicly available information. management meetings, trade resources, the competitors, suppliers, people within the industry. Anything we receive from the company, we always fact check through other sources, just because there's obviously a lens there. There's a view they're trying to convince you of. I mean, the data never comes from one source; it comes from multiple sources. But a lot of, the most interesting information we gather is generally out of our industry research. So talking to the customers through channel checks, in the Freshie case, actually talking to the franchisees and verifying a lot of what what management has said. So beyond just the traditional unit growth, we look for free optionality, and they've got some unique partnerships which we really think can drive brand awareness. They've got a partnership with Walgreens down in the U.S. They've got in their first Walgreens store in New York. They got a partnership with Air Canada. We only reimburse people who travel at Pender for buying Freshie on Air Canada flights now. And they got a partnership they just signed with Shell. So they've got all these kind of options that are built in that can help increase brand awareness and increase the scale of the business. The second optionality for the company here is innovation outside of what they're currently doing, either through meal boxes, breakfast. Right now, it's about 80% of their revenue is driven through lunchtime crowds. So they've got that opportunity to expand it to breakfast. Online has not a big part of their business right now. You look at the success Starbucks and Domino's have had. So there's a lot of optionality for growth here. Sorry, lunch is greater at 50% of sales. So when we look at this, though, it's really, you look at the near-term growth. Right now, they have about 400 franchise stores open around the world. And they've guided to saying they're going to have 330 to 350 new stores by the end of 2019. Here's a company that's under-promised. Over-promised. What's our conviction here? Well, they actually have 150 stores in the process of opening right now, and they have 375 new stores committed with fees. So we think this is probably a management team that, over-promised coming out of the gate, has learned a lesson, and will probably underperform or under-promise for the foreseeable future.
Do you think the unit economics of the new stores might be affected? Because the first stores might have better locations, or something like that?
I mean, it certainly comes to play eventually, but you look at Subway, you look at Starbucks and the saturation they have. It's not an issue we're overly concerned about for the next 5 to 10 years, but it's definitely something worth keeping an eye on 5 years out. Operational leverage is in sight here. So, they've built out the infrastructure, and, average unit volume for a store is 535,000. This generates about 35 million of royalty revenue, driving operating income of 24 million. So the incremental margin per store is about 53% right now. So that's wonderful for Freshie. And you can there's our model. It's an illustrative example of how we think 27% top line growth can drive about 57% growth on the earnings side for the business. So the valuation today, just with what they've said, getting to their adding 330 to 350 stores, it's trading at about 8 times 2020 EBITDA. If you look at all the US high growth comps, they're all trading at 20 times EBITDA. So we kind of combine this with 90% cash flow conversion and 50% incremental margins, 45 to 30%, 45 to 300% upside from where we are today. Risk, it's one of the final slides of the presentation, usually the first one on the investment team meeting. We look at what we call the Trinity of Risk. So it's first is balance sheet, second is valuation, third is operational. Balance sheet financial risk here is low, net cash flow positive. Valuation risk is moderate. It does look slightly expensive in the rear view, but it's pretty attractive with the growth factors factored in. And then business and earnings risk is moderate. I mean, consumers are fickle. We might all realize that vegetables are really bad for us next week, and everyone will stop going to Freshie. I guess maybe we should, have a barbecue hedge or something. I don't know. QSR is extremely competitive. We know every time I talk about Freshie, someone will come up to me and say, "Oh yeah, but we've got this awesome bowl place that has better, fresher food just down the street from it. I only go there." I'm like, okay, I understand that. That exact logic is the subject of a wonderful bet between Felix and I in 2009, where we were in probably April or May 2009, we sat down and we said, okay, so your best stock pick for the next 5 years against mine. So I chose this little micro cap, and I did pretty well on it. He chose Starbucks. And my initial response, and I'm gonna show my Vancouver roots here, I'm like, Starbucks, that coffee's terrible. There's like all these great coffee shops. Why would anyone buy Starbucks? And so I didn't buy the stock. Well, the stock was at $7. I don't want to tell you where it was today. So that was a very expensive lesson for me, a mistake of omission. It's 12 years right now. They have 400 units in place. These guys have been very successful. Matt's a really scrappy founder. He knows the business extremely well. We think that mitigates a lot of the risk. And there's really no incremental capital needed to grow this business through the franchise model. So the summary on Freshie, it's a missionary CEO. We view this as a compounder. We think it can grow at mid-teens rates of return for a really long period of time. It's got temporary headwinds. As we always say on our investment team, we see two types of companies. Companies that are having problems and companies that are going to have problems. It's way better buying companies that are having problems. And these guys they're a proven innovator in QSR. There's a whole bunch of secular tailwinds, health and wellness, affordable entrepreneurism, and the millennials. And the growth's right there. Read through their public disclosure. Unless you think they're going to have a massive miss again, the growth's in hand. So that's my presentation. And we'll get back to the Q&A.
You kind of touched on it a little bit already, but I was just wondering about your approach to shareholder engagement. So do you find that most small cap companies are fairly receptive to you talking to them? And if they're not, what do you do then? You just walk away? I mean, it's not practical to go to the newspapers or to just buy so much that you can start a proxy fight and get on board. How do you kind of approach that when there's pushback and just sort of overall?
Yeah, I mean, the answer always is it depends. We invest in companies because we want to be there for a really long period of time and we see a wonderful opportunity. So usually when we're investing, we are very like-minded with management when we do so. If there is a need for activism along the way, it's a result of a divergence in opinion on how the company can best do that. You see a lot of the really exciting proxy battles and the public disclosure. I mean, that's, you kind of have to be willing to do that if you want to do the right thing long term every now and again. But generally if someone, the type of person who's going, the type of people we like to invest in, they're generally pretty open-minded. They want to do the right thing for shareholders. So it's, usually if, you look at the companies where there's been hostile takeovers in the past, and there's usually someone running it with a really big ego who just telling shareholders where to go. And that wouldn't hit our management filter. We would just have avoid that company right out of the get-go. So we kind of avoid those public fights by self-selecting out of investing in those companies in the first place.
Dave, is it possible to make copies of your slides?
Yes, I think so.
Yeah, we can, I'll post them on the website if we get permission from you, we can post them on the website.
Hey, just one more question. I think you've got a hard close on your small cap fund?
Yeah.
Mark?
So how concentrated or how diversified your portfolio is?
So what we always try to do is have the top 20 in the portfolio be about 80% of the invested portfolio. My comfort level is kind of in 3 to 5% max position sizing in our small cap portfolios. We'll go more concentrated in our larger portfolios. You'll see on the small cap side, we'll get up to between 30 and 50 names. A lot of times that's we're either exiting a position or building a position, but really it's the top 20, which is the key driver of the portfolio.
Mostly in North America.
Small cap is, we do a little bit outside North America. We have 8 people on the investment team. All of us wake up every day looking for opportunities in North America. Where we venture outside is, where we're looking at a company and then a competitor's in London or, somewhere else, and then we'll take a look at that. Particularly in small cap, you need to be closer. In venture capital, you need to be in the city. I think in small cap, as long as you're, 1 flight away or 1.5, everyone's gonna ask me what half a flight is. It means 1 flight's 5 hours, a half flight's 2.5 hours. So as long as you can get there in a day, you can keep an eye on this thing.
Sorry. Yeah, hi. Can you talk about your search process? Obviously, with a company like Freshie, you're kind of taking a view into the future of what it could be or what it should be in your opinion. Like, how do you go ahead and screen for those type of companies?
Yeah. So Freshie's a good example because we originally met with them on their IPO, and we liked the business. We did not like the price, which tends to be the case in a lot of IPOs. And we did a bit of work, recognized this was a small cap, there's probably going to be some volatility, and we just wanted to make sure that we were positioned so that if there was an opportunity, we could move quickly and build a position on it. So that's just a situation where we saw it in the IPO in January 2017, and then a year later is like, okay, we have an opportunity to actually buy this company. And so a lot of people say, where's your idea come from? And a lot of times we don't know. Another company in the portfolio right now is Absolute Software. It IPO'd in the .com boom. I saw them on their IPO roadshow, and I've been following it ever since. So, how does that get in the portfolio? It's just you start following these businesses for a long period of time, and then when something happens to either there's a transition in the business value to make the current stock price look attractive, or if there's a temporary headwind so the stock gets hit and you can buy it cheaper, then you can act quickly. I think a lot of our ideas come through recycling, revisiting names we've been in the past. A lot of them come through industry research. So when you're out there talking to companies and starting to understand who they're competing against, sometimes you'll find that a competitor's better positioned. Sometimes you'll find a supplier in the industry which has pricing power over all the competitors, so you actually go to a different part in the value chain. We don't do a lot of screening. I think there's just so much data out there. Can you actually build a proprietary screen to find ideas that others aren't? That seems to me like something AI's, if they're probably doing it already and we don't know about it. So that seems pretty challenging for us. So for us, it's more about understanding the businesses and having that comfort level so that we can apply what we think is one of our advantages, and that's a behavioral approach. So understanding the business and then buying it when people hate it.
Can I have a follow-up question? Can I ask about your business? Set up as a mutual fund, you have like an amazing performance over a good amount of time. From what I understand, the mutual fund structure is almost a way to performance in a sense, right? Like, how do you deal with investors, making sure that they stick with you as the times are good, and if times that we get there, how do you make sure they're not putting you out at the same time? And have you ever thought of doing a different structure, like more of a hedge fund type structure to help out with that?
Yeah. Yeah, it's like even hanging out at the Pender strategy sessions. I mean, the hardest thing in this industry is, I mean, you know, I'm incredibly emotionally inverse, okay? And, you know, I know when a stock's down that it's really cheap, and, you know, I get really excited, and I know we're gonna make a lot of money on it. I mean, then we had an investment team meeting, or a dinner the night of the Brexit news came out. And we were sitting there having dinner, and then the news came out that, oh my goodness, they're leaving. And then so, you know, all of a sudden we're like, wow, there's gonna be crazy volatility. And everyone's kind of at the dinner table like, oh. And I'm like, this is great. I mean, let's go home. Like, I want everyone's top 5 ideas in the, like, before the markets open in the morning. So if things are gapping down, we're backing up the truck. And Felix starts laughing at me. He's like, you're so crazy emotionally inverse. How do you do that? But how tying it into your client base, because at the end of the day, you're right. I mean, we have on our small cap fund, it's weekly liquidity. People can, you know, redeem every single Friday. And so there's things we do in the portfolio to manage that potential risk. But we also, you know, Pender, we're lucky. We have a really wonderful relationship team. And I think we try not to talk about performance. You know, I'd be foolish to think that our relationship team is not talking about the performance given what we've done, but it's really educating and talking to people and trying to attract investors who believe in the process and understand what we're doing. And I think, you know, I've met with a lot of the investors and the advisors who invest in our funds, and I think we're really lucky to have a very knowledgeable client base who understands what we do and are very long-term in perspective. But you know, it's definitely a risk. In the back there.
What are your thoughts on valuing companies and the process or processes used to determine value?
I mean, I think we use several methods. My personal favorite is private market value. Just knowing what someone would come along and buy the company for today, you know, that's value to me. And then if I can buy it at a discount to that, you know, that's more relevant in small and mid cap where there's, you know, more potential buyers of companies. We'll also look at things, you know, liquidation analysis in our bear case scenarios, discounted cash flow models. If we're having a hard time on private market value, depending, sometimes we'll use a sum of the parts if it's a bit of a conglomerate and we think there might be some catalyst forming around it. It does depend. But I mean, what I would say is, for me, it's you know, my best method is private market value, and I think it's a very personal question for most investors. Everybody, you know, you have to understand what works for you and stick with it.
When it comes to Freshie, my gut's kind of telling me that I feel like they're benefiting more from first mover advantage, just given their distinct brand and menu offerings, as opposed to having a sustainable competitive advantage. So I'm just wondering if you could share your thoughts on that, especially in relation to more established QSR brands that have more established footprints that could move in on this space. And so which of the two do you think it is, if it's neither or, between first mover advantage and sustainable competitive advantage?
Well, I think if you would have looked at Starbucks in the early innings, you would have asked that exact same question. I mean, if you would have looked at McDonald's in the early innings, you would have asked the exact same question. So I mean, I think that's the exact question which causes most value investors to underestimate the potential in these types of companies. You know, it is first mover advantage, which then does translate into a more sustainable moat and brand as we move forward.
Yeah, thank you.
You said that when you first met them, quote me right, you thought they were arrogant and unrealistic. Why do you change your view on management today? I think the quote was, I think the general view was they were arrogant.
you know, we didn't think they were going to hit their growth numbers, right? But what we did have strong conviction in was their ability to operate and continue to grow. You know, I think there's smaller companies have a lot of growing pains. The first time you go out as a CEO and talk to the financial community, you're going to make some mistakes. You hope it's a small one. In this case, it was a big one. I mean, their ability to forecast and provide guidance to the financial community has zero impact on our investment thesis. It really just gives us the opportunity to either buy the stock cheap or sell it when it's expensive. So for us, you know, what we zeroed in as part of the initial meetings is Matthew and his management team, are they doing a wonderful job? Are they doing all the right things internally in terms of building the business? The noise, it's not as relevant to us.
How do you get comfort over pricing the growth? Like, especially you were saying for 2020, you are like EBITDA to 8, right? So it's all built into the future growth, right? So do you have any specific target, like I won't pay more than certain EBITDA or certain E? With this kind of company, like as you were saying, they don't have to deploy capital, so there is not bigger balance sheet, I'm guessing, so the whole value in the P for the future. How do you get comfort on pricing this kind of company?
Yeah, so in this scenario, I mean, they've already, you know, in order to hit their growth 18 months out, they just have to do what they've already signed. So they just have to do the things they've been doing well for the last 12 years. So we have pretty good confidence in that. And based on that, you know, we think this, if they just do that, we think the stock's cheap. And then on top of that, there's all this additional optionality with their unique franchisor agreements, and then some of the optionality with some of the partnerships they've signed. So it's really, you know, we can look at the income statement 18 to 24 months out and probably be in the 80 to 90% confidence range on that. And we know what that business would be worth at that point, so we think it's a nice opportunity here.
You set a key target that you want to go with or a target, like you won't buy, even if the future looks good, you won't buy if that doesn't mean that hurdle.
What we try to do is understand the underlying earnings power of the business, and so it was the answer always on valuations, we have no hard rules because it depends, and it's really hard because growth has such a large impact on any valuation model you're going to do. And so, but if you look at what, you know, in the case of a freshie, the unit economics, you open up a store for $250,000 and the franchisee's making $100,000 a year at the end of the day. I mean, that's, you know, there's wonderful unit economics at the franchisee level, and then they're taking their top line cut, and they kind of know what their revenue is going to be off every single franchise that opens up. And then we also know that, you know, there's really high incremental margins on all those royalty revenues that come back at the end of the day. And so, you know, when you look at the PE today, when you look at the PE in the future, we have no idea what the earnings are really going to be, but we have a pretty good understanding what the earnings power of the business is. And I think, you know, the classic example right now is Amazon, where, you know, on a PE basis, it's crazy expensive. And as long as Bezos has what he thinks are wonderful 7-year investment opportunities, it's going to continue to always look expensive. But what is the underlying earnings power of that business? I'm a small cap guy, so that's on my too hard pile. But I mean, I think there's tremendous earnings power there at the end of the day. But are you ever going to be able to buy that stock looking at a dogmatic PE approach? Never.
Just interested in that particular example, Freshie. What do you estimate the return on incremental capital to be compared to its cost?
We don't look at it. I mean, we do. Just it's not one of the key factors which drives what we think the business is going to be worth. It's it's basically 90% incremental margins on royalty revenue, with 50% net flow through to the bottom line.
But then it would be a very high return on.
It's very high, but if they continue to, and if you look at more classical industries, return on invested capital is a lot more relevant because you're capitalizing assets, and then it's flowing through your balance sheet, and your earnings are you're not getting the earnings hit of the reinvestment in the business. Whereas in more of these people-based businesses, if they go out and hire a bunch of marketing people and product development people, the E gets suppressed.
Sure.
So it's return on invested capital is.
But surely, assuming your growth is coming from reinvesting in the business, then your return on that incremental capital defines the ultimate value of that business. Because assuming they retain all their earnings and they're going to reinvest in the business, then it can only grow. Now this is going to be incredibly high, because on a franchise model there's not much.
It's incredible.
Therefore, the question is how long does that last for, I guess. So I still think it's irrelevant, my personal estimate is a relevant number to define how good this investment is compared to something else that you might do. With similar characteristics of competitive advantage. That's fine.
Yeah, so I mean, if you look at it, I mean, they're at 400 locations right now, and can they get to 4,000 locations? So increase tenfold? Yes, we think they can. So you plug in what your return's going to be on that, and
You're going to get a very big number.
you're going to get a crazy number. It's actually more about looking at the risk factors and the execution.
Sure.
What is the cost of capital of this company? It's just spitting out so much cash.
Yes. So it should be fantastic. As you say, the risk.
Well, in theory, yes. Yeah. Oh yeah, the one caveat I have is nobody buy Freshie today, after this, because every time I talk about one idea, it's always the one that doesn't work out. So I'll put that disclaimer out right now. We do this conference in Vancouver. We did it for 6 straight years, where we'd have the 3 or 4 of our investee companies come out, and then I'd kind of do an intro, and we'd do a theme, either capital allocation or high growth companies or something. And we'd have 3 or 4 companies that we thought were wonderful investments at that point in time. And it was really interesting because about year 3, what I started doing was I started doing a report card. And the report card was, would you have done better if you bought the 3 or 4 stocks, or if you just bought the fund? And it was about over 5 years or 6 years. It was 5 years the fund outperformed the best ideas. So that's the caveat right there.
I feel kind of tired, so hopefully this is not a stupid question. What do you think the loss is right now, the margin of safety?
Margin of safety, it's our intrinsic value estimate. It's about 60% margin of safety right now.
What else I was going to ask you? What do you think are the best catalysts to close the gap in general?
In general? So I would invert that and ask you, what are the key characteristics of value traps?
I think one trap could be a low PE ratio. You get a very low PE ratio, it could look attractive, it could be a value trap because they can never run belly up.
Yeah, I mean, I think, you know, whenever you hear someone sitting there saying, "Oh, I got stuck in a value trap," it's a company that wasn't growing, or was even in decline. So the inverse of that is if you have a really high growth rate, your potential catalyst has a way higher probability of forming. So I think growth is a wonderful catalyst for closing the discount. I think operational execution, particularly in the case of Freshie, is a wonderful way to close the discount. Our favorite is being attractive to a third-party buyer, having someone else come along and buy it. I mean, although that creates more work where you have to go find another great company, which it's always one of those good news, bad news. The salespeople love it when a company gets taken out. It's bad news for the investment team because we have to go replace it.
Hey, I have a question regarding since like the smoke funds closed, right?
Yeah.
So how did you originally think about capacity? When did you end up closing it? And then maybe as a follow-up question, maybe whether you think you would perform better if your assets were more limited, so smaller. We still invest in the same stuff that you always do.
Yeah, I mean that's.
So, and is it the same fashion, or has it been impaired somehow?
So small cap, I mean, the average market cap size in that fund was always about 200 million. So we capped it when we got to 150 million. So that enables us to, if you think about it, $200 million portfolio, 3% weighting is $6 million. We can still get into a $50 million company, although we'll own 10, 11, 12% of it. So we can still get into those $50 million companies that we'll venture into, and not a lot of people will.
A little more general, is there anything when you sit in front of a company or industry that you have absolutely no interest in turning off when you're looking at investment, even if there's value?
Sorry.
Is there one or two items that you would look at when sitting with a company or looking at an industry that would just turn you off? You have absolutely no interest.
I'm not all that
Financial
interested.
or managerial or
Yeah, I mean, we live in this day and age where we're just totally inundated with data and information, and I mean, you can just sit there and read about interesting stuff all day long. And it's not so much, is there something that turns you off? I try to focus on things that I'm really interested in. So if I'm not interested in right away, I'm not going to dig in on it. There's certain areas I just don't. I'm not big in the resource sector. Their commodity businesses doesn't interest me, and B, they're commodity businesses. There's no pricing power there. There are red flags that come up along the way, like if there's any hint of management dishonesty, we put a big red flag on our file, so that if anyone ever picks it up, they know. That would be the big thing. There's certain business models we don't particularly like, but usually those will kind of go onto a watch list as opposed to a don't touch. Does that answer your question?
So you have a concentrated fund, small cap, you like stocks that everybody hates. So you buy a stock and it goes down from 10 to 5. Up and down, you buy more. How do you guard against the right trap?
The answer is it depends. If a stock does go down, if it's moving against us, we'll dig in and test our thesis just to make sure we're not missing anything. But if we still have the conviction, we'll increase our position size. But
do you have any sort of checklists that give you red flags about right traps?
I've got a slide from a presentation I saw Jim Chanos give a long time ago. So the best person to identify value traps is someone who's looking to make money on stocks going down. And it's more looking for industries in decline, big balance sheets, regulatory risk, things of that nature. So we've got our checklist. I mean, we're not just, we love growth companies because it gives us the ability to compound for a really long period of time. We also like more classic value investments because you can make really nice rates of return off it. In the case of, and that's where you have to be a bit more aware of value traps, and that's kind of to tie into the question over here. And it's really about revenue growth. If companies are growing and creating more value, and that value's, if it's building on a day-to-day basis, that's you're less likely to get stuck in a value trap. I mean, the facts always change, and businesses can have hiccups. But a sort of slower growth, you have to be a lot more aware of the potential for value traps. And then we just tie that into our pricing and our trading. So if we view something as, we call our companies which we think can grow for a long period of time compounders, things that are more, classical Ben Graham, where we think they're really cheap right now, we call them close the discount. We are way more ruthless on the margin of safety we demand on a close the discount, and we're way more active selling our stock as it gets closer to fair market value. Whereas compounders, we tend to let run, and we're not as, if we think the stock's trading at a 40% margin of safety and that's appropriate, and it goes up and it's just a 35% margin of safety, we'll probably build a half position. And then if it comes back to us, then we'll build a full position. But price in compounders, actually, this sounds terrible at a value investing conference, but price is not as crucial. The price you pay is not as crucial in a compounder as it is in a traditional close to discount situation.
One question. You've not shared any past financials about this company. For example, last 5 years, 7 years, what the growth rates have been, what the EPS growth has been, what the ROIC has been, and what the capital allocation within the company. One of the big value traps apart from growth is actually the capital allocation within the company also. So, you have any slide on that?
I don't. I mean, the financials are all publicly available, so I was trying to share.
What will be the EPS growth, for instance? 7 years?
Not. Sorry, I have to go back to my notes on that. But I think when you're looking at a company like Freshie, I was going to key on one question you mentioned early on. Repeat the question again.
So I wanted to know about the past financials of the company, just to give an understanding what the ROICs are in the last 5-7 years, and it trending upwards, for instance. What the EPS growth would have been in an economic cycle, if consumers might have thought the growth is happening in terms of SSG for the last 7 years or something like that. And then third would be, what is the capital allocation within the company? Are they really paying out money back as dividends? Where is the capital being used? The retainer is being used. Yeah.
So I had the slide on the same store sales growth, which.
Yeah, I saw that. But
okay.
I'm saying in
top.
terms of
It
would have been.
So I mean, this is kind of illustrative. I think what your point on capital allocation. So you look at the historical financials and you look at the store footprint they currently have and what they have signed. That is what it is. It's your point on capital allocation is great because in growing companies it can be a huge issue in terms of does the value actually stick to shareholders' bones? It's less of a risk in the early stages where these guys are going to go out and they're going to sign up more franchisees. Okay, the risk on poor capital allocation around here is what is to the point. A question in the back was what happens when you start to get to store saturation and growth starts cannibalizing itself. I mean that would be that risk. The other side on the capital allocation side is, it's Matthew owns a ton of this stock. His family owns a bunch of it, and usually, when people are big shareholders, capital allocation policies tend to be a lot better than if they are, it's a professional CEO with a $3 million salary and basically no stock. Do we have full conviction that he is going to make the right decision every time? No. But we've just, you kind of see founders in the past and founder-led companies actually have an above average history of capital allocation. But as of yet, he's unproven.
The issue that happens with consumer companies, especially at the cost of setting up a template or having a successful business model, is typically very front-ended. You experiment with a lot of universities, R&D for instance, to learn what it is, and getting the store designs right. So the capital allocation here hardly stems with are you diluting a lot of equity or not to fund the operations initially.
So he doesn't need capital to fund the operations, right? Okay. It's self-funded.
So no dilutions for the last 5-7 years.
There was a secondary on the IPO, and they raised capital on the IPO, but they're highly profitable today and they have a strong balance sheet. So yeah, I mean, certainly when you're looking at microcap and small cap, you have to be very vigilant of dilution. It can be the biggest detriment to actually generating returns. I mean, that's really low on our risk meter for this company.
The last question. Tyler, you have a question? Last question, I guess. What's the most important thing you learned in the last 15 years investing?
The most important thing? There is no most important thing. It's a wonderful field. Every day you're hopefully learning something new and you're improving your process. It's humbling. I think I'll retract that. I think the most important thing is to stick to your process. It's absolutely stick to your process. It's when you deviate, that's when you get into trouble.